have Vinay Khattar, who's Senior VP, Head Research at Edelweiss Financial Services, joining us with his assessment of the market situation currently, global as well as local. Vinay, it's great to have you on the show. Good morning. Thanks very much for taking out the time. This morning is a busy morning, and we've talked enough banks. So I'll start off with technology because in just the countdown to in-fee earnings, Wipro has sounded out a profit warning. How are you going to be looking at what Q4 earnings lays ground in terms of the trend for FY19's numbers?
Hi, morning to your viewers. So, our sense is that, first of all, I mean, just in terms of technology, we don't see too much of an earning uptick happening, at least for this quarter's. Even if 2.5% kind of CQGR is maintained, it's a reasonably decent number. Though there was some expectation that post the Trump tax cut, the BFSI space should pick up. And in that context, the commentary this quarter of most of the IT players with exposure to US BFSI would be interesting to watch. But that's about it. We don't really see too much of an uptick happening in the IT space, especially in the current quarter. Now, coming specifically to FY19 earnings, there is a clear uptick that we are seeing for companies across board. Last year saw very muted earnings. Our sense is that FY17 may just close at 7% PAT. Part of this was GST, DMON, so on and so forth. And if you were to look at last 3-4 years data, every year has been just about 3 to 5 or 6-7% kind of growth. FY19 should be a breakout year. 18 to 20% is what our expectation is. And that should then continue maybe for a year or two. And this is going to be far more broad-based. Our sense is that auto, metals, NBFCs, some of these sectors should do very, very well over coming few quarters. The earnings uptake will be driven not only by global commodity space, which will cause uptake on the domestic commodity basket, but the domestic consumption and the infra capex expenditure. If you look at the road sector, the kind of order book flows that we are seeing, most of the companies are sitting on a book-to-bill ratio of close to 4. And there is more to flow. Next 6 to 7 months could see significantly larger order inflows happening for the infra capex players. So that is the way to look at the market. The earnings growth should become very, very positive. And in that context, Nifty's current levels become interesting. Internationally, if you were to look at the overall data, the interest rates are up, the bond yields are moving up, the spreads between 10-year minus 2-year, that is really down, which is a cause of worry. Libor minus OIS spreads are down, so are up. Sorry. So that clearly tells you that international macro is not very, very pleasing. It could cause some reactions globally, which will have impact on Indian markets. But if you were to look at the Indian markets in the context of domestic earnings, current levels could provide very interesting buying opportunities with next 2 to 3 year view. That's our sense.
But we just had a conversation with Adrian Mowat, a renowned EM equity strategist, who said that aside of the Axis Bank and ICICI Bank news this morning, which we'll come to during the course of this discussion, it's HDFC hiking rates. I think it's been 5 years since the previous cycle. That is really giving the market the signal that, look, the price of loans is likely to get expensive.
That's one way to look at it. But if you were to look at the near term, the bond yields, government has kind of cut down on its H1 borrowing target by a reasonable number. We saw the bond yields correcting. And then we saw the commentary by the RBI in the previous meeting, which again spoke of a benign or a controlled inflation. And our sense is that scenario is likely to continue for at least next 3 to 4 quarters. So the stress on the bond yields is coming down, and you are seeing that on the 10-year paper, the yields are coming down consistently. And that's one reason why you saw even NBFCs beginning to trade higher. So the cost of capital going up for banks or NBFCs does not look likely to be an immediate scenario. If there is mispricing of the liability side, which had happened earlier because of competition and so many other factors, probably you could see some corrections. But are we structurally headed for higher cost of funds in the next 3 to 4 quarters? Our sense is clearly no, and government is going to remain pretty sensitive. given the fact that it's going to be an election year. And if I were to just take a deeper dive into this, in an election year, if the cost of EMIs begin to go up for large section of middle class, it's not going to be great news. If you were to look at the rural India, the real earnings growth in last 3 to 4 years has been practically zero. So middle class is one of the key core constituents of the current government. And I don't see cost of funds and EMIs really going up in this year, which could have larger ramifications, so to speak.
Vinay, tell me, what is the chatter though at the HNI desk, since you do track their moves rather closely? I assess that they would have sold some, partial core portfolio when the LTCG tax was actually implemented. And then there was that big shake-off in February as well as March globally, and we also came off 10% from the top. Having said that, have HNI selectively been buyers in this decline, or have they completely evaded the market and sitting on cash?
So that's a good question that you asked. We saw a significant amount of deleveraging happen post the budget. Large sell-offs happened led by the trigger of LTCG, but international pressures were anyway there. Plus you saw FIIs also being pretty muted. So a significant deleveraging of position actually played out in the month of February, and to a certain extent even in the month of March. Currently, the valuation piece is becoming quite attractive, as we all know that HNIs have got a significant exposure towards mid caps and small caps, and we are beginning to see some degree of selective buying playing out in this particular segment. So there are selective buys happening on the infra side, maybe on the auto. Mid cap IT, which was aggressively lapped up, is kind of cooling off. So there is selective buying which is happening within sectors, but is it a broad-based, all-in kind of a scenario? Definitely not. I think there is a lot of wait and watch attitude. This is going to be an election year, as we mentioned earlier, plus there is going to be international volatility. And valuations are not really dirt cheap if you were to look at it from a point of view. So there is a lot of wait and watch attitude which is playing out. Our sense is that should the Nifty go down by another maybe to 9,600 or 9,700 kind of levels, it's been testing about 10,000 again and again and going up. I think that those levels will become very, very interesting. If you have to just put in some numbers, FY19 earnings are likely to be at about 600 and FY20 at about 700. As we enter into H2, that means around August, September of this year, market will start looking at FY20 earnings, which will make levels around 10,000 very, very attractive from just to the price to earning multiples point of view. So sideways at the current juncture, but a lot of people are in wait and watch mode, and if the markets correct another 400, 500, 600 points, I think buying opportunities will emerge very aggressively.
Optimistic to me, Vinay, but if I could just come back with some very basic data points here. FY18 numbers will nowhere be close to consensus, and I get a similar kind of factor would be at play for FY19 as well, because you don't know what banks would do, you don't know what NBFCs would do. So that's the gray area. There is going to be rise in volatility because of fear of a trade war, or there could be impact of high crude prices. So my challenge with a bullish assumption right now, and that's my personal view, is that earnings recovery continues to disappoint us, and I think this would be for the 7th year or 6th year in a row that we will have single digit growth for Nifty.
Nikunj, you are absolutely right as far as the current year is concerned, and you're bang on when you say that for 5-6 years we've got very low single digit kind of earnings growth, and that's where the silver lining is. We've had so many structural changes, especially happening in the current stint, and which are likely to have a significant impact as we go forward. Let's look at the broad economic structure, the way the economy has been running. We've had practically no exports growth in last 5 to 7 years. FY12, India exported goods worth $300 billion. FY18, we will be exporting goods worth $300 billion, still the same, practically zero growth. So that one important growth engine is missing. And within this basket, the primary growth has happened on the manufactured goods side, which has shot up to about $76 billion, which means that our other sectors like textiles and gold and jewelry have practically shown stagnant or kind of mild degrowth, and these are also very heavy job creating sectors. Coming to the second part, which is the domestic consumption story. Domestic consumption story has not gone anywhere, with government's focus on lower expenditure, controlling inflation. Both the rural and the urban side have really not seen consumption happen vigorously. And this year's budget, you clearly see that as a key government focus area, where a lot of focus is going on to the rural side. I think there is going to be flow through on the domestic side also, on the urban side also, which means the consumption engine, which was the missing piece, should begin to rev up. The third part is the infrastructure. Government's focus on road has led to serious order book growth. I think a lot of the traction on the road and rail should begin to percolate to the normal economy. If you look at some of the numbers, just the book to bill ratios of the road sector guys, or the flight plane load factors, almost 18-20% kind of growth. Most of the companies are operating at 85, 90, 90% plus kind of plane load factors. So you are seeing green shoots happening. Now, if the overall economic traction begins to play up, our sense is that the earning growth is a matter of time. It's going to come in. You look at the last quarter's numbers, you look at this quarter's numbers. I think most of the brokerage houses are putting a PAT growth of mid-teens. 2-3 quarters ago, this was a real ambitious target. Over the next 3 to 4 quarters, can this mid-teens number becomes high teens? I think it's the way forward. So the growth is going to happen.
Vinay, I absolutely agree with your point that if there is growth visibility, it's these consumption spaces, aviation, and it really is a proxy to consumption nowadays. And the other one, roads, wherein in the run-up to the 2019 elections, the order flow is going to be extremely heavy. But again, within these sectors also, there is divergence. There are companies which are better. There are stocks which are looking expensive. So how is it that you pick and choose, Vinay? Would you have a list ready as to what one can buy within aviation as well as the road sector even now, even at the current valuations?
So our topics have remained pretty consistent in the road space. We continue to like Dilip Buildcon, PNC Infra, and Sadbhav. You see, there are multiple factors which are playing out. Most of these road guys are picking up on execution very, very aggressively. Number of them like Dilip Buildcon and Sadbhav are earning handsome bonuses by completing projects before time. And that is kind of adding to EBITDA and return on capital. If you look at the road sectors, the earning growth happens because of executions, but PE multiples are driven significantly by the size of the order books and book to bill ratios. And those, if you look at just the TV headlines, no day passes where one or the other guy comes in and reports 1,000 crore or 500 crore or 2,000 crore order from NHAI or somebody or the other. So that trend will cause the PE multiples on the road guys to expand. Most of them are available at reasonable values. These are not cheap because one uptick has completely happened. So these bets like Sadbhav and Dilip Buildcon could be very interesting going forward as very decent compounders with 2 to 3 years views. Our sense is, if you look at the China example, during their growth phase when a lot of money got into infra, they created multi-billion-dollar companies. Some of the Indian names are going to become multi-billion dollars name by the end of this next 5 or 10 year period.
Okay. We'll close out with the question on the topic at hand, which is banks, and how are, what are you picking on in terms of H&I trends and how they're approaching this Indian financial crisis, as we're calling it?
So banks have continued to surprise us again and again on the downside. We've been thinking of end of this entire stressed asset cycle, and every quarter brings in a new surprise, and all the analysts keep on reporting that probably we are at the end of it, and we've been having the same conversation in TV studios for a very long time. So there is a kind of exhaustion, there is a kind of wait and watch attitude which is coming in, and people are tilting more towards play the scene cards, and the scene cards in this space is the NBFC space. If I were to just give you some basic numbers, the public sector book at about 27 lakh crores today has become almost equal to the private sector book and the NBFC book of about 27 lakh, public sector book is about 52 lakh crores and private sector and the NBFC books are close to about 27 lakh crores each. The profit pools have shifted significantly from public sectors to private sector and to NBFC. Each of them today, NBFCs and the private sector banks make about 40 to 45,000 crores of annual profits. Public sector lose that much amount, would be losing that much amount this year. So the scene card is to go towards the NBFCs. They are capturing market share very, very aggressively. They were just 12% of the market in 2015. In 2005. Today they are close to about 24-25% of the market share within this space. So a serious capture of market share has happened over last decade by the NBFC, and the profit pools are clearly indicating that they are growing forward. Now, within NBFCs, what do you play? There are housing finance companies, there are truck finance companies. As I mentioned earlier, we see that auto cycle picking up very vigorously. CV sales are going to be trending upwards of 20% on a consistent basis. Passenger vehicle sales are doing very well. If I were to just throw a data point, Tata Motors, which was one of the last players on the passenger vehicle side, the seventh player, has been growing at 22% in the last 4 to 6 quarters. They have now become the number 4 players. And a lot of these passenger vehicles and CVs are financed. So you could have the players like Chola Mandalam and all could be very, very interesting bit going forward. The NBFCs which have exposure to the CV space. Similarly on the housing finance side. So these are the two spaces within NBFCs which could be very, very interesting. So my sense is avoid banks till the time you have more clarity. Public sector banks could be very interesting bet just in terms of valuations, but you don't have any clarity when will this pain stop and to what extent it's going to go further. So play the scene cards. Next 1 to 2 years investment in NBFCs could be a lot better bet, especially given the benign, the interest rate cycle easing off with next in the near foresight.
Speaking with you, and thanks much for that in-depth analysis on what the HNI activity in the street is like, especially given the market fall in February as well as March. And yeah, Vinay continues to believe that stick to quality, stick to NBFCs, roads as well as aviation. That's where the growth is, and growth is visible at that, irrespective of how expensive the valuations may be in some of those stocks.